The Psychology of Money isn't a book about finance. It's a diagnosis. It exposes how your mind quietly works against you and sabotages your wealth. You can master every investing rule. You can read every strategy. But if you don't understand your emotions around money, you'll keep making the same mistakes. Because money isn't just logical, it's deeply psychological. In this video, we'll uncover the hidden mental traps that silently destroy your financial future and the mindset shift that help you level up and escape them one by one. Before we dive in, if you want to be successful with money but constantly feel overwhelmed by it, you're not alone. That's exactly why I built the Money Mastery System to help you finally take control of your finances. It's an all-in-one Notion system that gives you the tools to manage money the way wealthy people do. Plan your spending based on what matters to you. Think long-term and stay in control without the stress. If you're ready to upgrade your financial mindset, check it out in the description. Now let's get into it. You're smart, you've read the books, you've done the work, but something keeps pulling you back because intelligence doesn't protect you from bias, it hides it. Your choices feel rational because they're yours, but that's the first trap smart people fall into. Trap 1, you think you're logical. Why do two people look at the same investment and make opposite choices? One buys, one sells. They're not wrong, they're just playing different games. As Morganell puts it, people do crazy things with money, but no one is really crazy. Everyone has a story that shapes how they see money. A stockbroker who lost everything in the Great Depression might never invest again, while a tech worker who got rich during the 90s boom might chase risks others would avoid. Or someone who graduated during the 2008 crash might fear the stock market for life, while someone who got into crypto in 2017 might believe volatility is normal. Same world, different lenses. You can study the history of the 2008 crash, but you'll never feel the emotional scars of those who lived through it and now panic every time the market dips. That's why two people can make opposite decisions from the same data and both be right. Neither is crazy. Think about that for a second. Your experience with money is just a tiny sliver of what's happened in the world. It's like living inside a bubble shaped by your past, but that bubble still shapes nearly 100% of how you see the world. Meanwhile, outside that bubble, there are financial realities you've never lived through. Trap 2, you think you're in control. Why do some people succeed with less effort while others do everything right and still lose? We'd love to think success is earned and failure deserved, but money doesn't work that simply. As Morgan Housel writes, nothing is as good or as bad as it seems, because behind every story of success or failure is a mix of effort, luck, and risk. And we often forget how powerful they really are. Take Bill Gates. He's not just brilliant. He's calculated, disciplined, strategic, exactly the kind of person you'd expect to win. But what most people forget is that in the early 1970s, Gates happened to attend one of the only high schools in America with a computer, at a time when computers were rare, expensive, inaccessible. That tiny accidental advantage gave him years of practice before most people even saw a keyboard. That single detail was a 1 in a million stroke of luck, and it changed everything. Now compare that to his close friend Kent Evans, equally brilliant, equally obsessed with computers. But Kent died in a mountaineering accident before finishing high school. Another 1 in a million event, but this time it was risk, not luck. Two brilliant minds, two wildly different outcomes, neither fully in their control. That's the point. You can do everything right and still lose. You can mess up and still win. It's uncomfortable, but it's true. That's why humility matters. Don't take all the credit when things go right. Don't take all the blame when they don't. And don't judge others too quickly. You never see the full equation. This also means be careful who you admire or try to copy. The more extreme the success, the more likely it came from circumstances you can't repeat. Because what worked for them might have depended on luck you won't get or risk you can't afford. So don't assume their playbook will work for you. Instead of idolizing individual stories, study patterns. Patterns are honest, repeatable. When you apply them, they keep working in your favor even when luck isn't on your side. And most important, patterns help you build a financial life that can survive bad luck. So when good luck shows up, you're still standing to receive it. Trap 3, you believe the story, not the reality. Someone hears a story of a baker who won $200 million in the lottery. Suddenly, buying a ticket feels like a smart move. Never mind the 1 in 300 million odds. The story feels good, so we believe it. Hey, maybe I'll be next, but that's not logic. You don't picture the millions who lost. You picture yourself on the yacht. The more comforting the story, the easier it is to follow blindly. Because when a story feels good enough, we want it to be true. So we believe it, even if the odds say otherwise. Morgan Housel calls these appealing fictions, narratives that feel good but quietly mislead us. And it's not just the lottery. We fall for the same kind of stories in our investing, spending, even saving decisions. Take the crypto boom. In late 2021, it felt like everyone was getting rich from crypto. Your neighbor, that guy on TikTok, even your Uber driver had a hot coin tip. Thousands of new tokens launched. Most had no utility, no roadmap, no real purpose. Just a name, a price, and a story. Get in early, don't miss your chance. This is the next Bitcoin. People didn't buy the math, they bought the dream sold by influencers with flashy lifestyles. Everyone said, this time it's different, but it wasn't. By 2022, the story started collapsing. Coins vanished, projects disappeared, billions were gone quietly almost overnight. But the warning signs were always there, and it worked because it felt good. So be careful what you believe, especially when the story feels good. Always ask, is this supported by data or just Desire, do I trust it because it's true or because I want it to be? Because in money, as in life, the most dangerous stories aren't lies. They're comforting half-truths we never think to question. Trap 4, you think you're a spreadsheet. We plan like machines, but we're humans. Spreadsheets don't panic during downturns. They don't compare, but you do. You feel stress, you have doubts. And if your plan doesn't leave room for that, it won't survive real life. That's why Morgan Housel says, aiming to be mostly reasonable works better than trying to be coldly rational. Because reasonable is sustainable, and sustainability is what actually builds wealth over time. Take investing. A reasonable plan helps you stay calm during downturns. It keeps you in the game when everyone else is panicking. Look at the stock market. Historically, it delivers positive returns. 68% likely over 1 year, 88% over 10, 100% over 20. But none of that matters if you abandon the plan halfway, and that's the hard part. You can build the perfect spreadsheet, data-backed, optimized, rational. But if it underperforms for a while, will you really stick with it? Or will you panic, switch strategies, and start over? Because the real threat isn't poor logic, it's emotional temptation. You don't lose money because you're stupid. You lose it because the world is loud and your emotions listen. Until you realize when your emotions are in control, you'll keep mistaking emotional impulses for strategy. Trap 5, you chase more than you need. Most people ruin their finances chasing more status, more validation, more admiration. Morgan Housel writes, there is no reason to risk what you have and need for what you don't have and don't need. So why do people who already have more than enough still risk everything for more? Take Sam Bankman-Fried for example. In 2021, at just 29 years old, he was worth over $20 billion. His company FTX had become the second largest crypto exchange in the world. The media called him the next Warren Buffett. Politicians praised him. Celebrities endorsed him. He was one of the richest self-made billionaires in history, and he was just getting started. But behind the curtain, he was quietly mixing customer funds, not to survive, not to feed his family, but to chase more control, more status, more admiration. But enough, that word was never part of the plan. So he kept pushing, and the empire collapsed overnight. Billions lost, investors betrayed, and Sam arrested, disgraced, alone. That's the danger of never enough. It's a silent trap, and most of us don't even realize we're caught, especially in today's hyper-connected world. You earn good money until you meet someone earning more. You buy a nice car, then someone else shows up in a nicer one. You feel proud of what you've built until you scroll social media and suddenly feel behind. Comparison has no ceiling. The more success you reach, the more the bar moves. Philosopher Bertrand Russell put it simply, it is impossible to escape envy by means of success. Even history's greatest weren't immune. Napoleon envied Caesar. Caesar envied Alexander. Alexander envied Hercules, who wasn't even real. That's how endless this game is. And the higher you climb, the harder the fall. But if your real goal is freedom, peace, happiness, you only win by refusing to keep climbing. You win by knowing when to stop playing. It's not about giving up. It's about refusing to trade what truly matters for what doesn't. Define what enough means to you. Draw the line, and once you find it, protect it. Because the most powerful kind of wealth isn't money, it's peace of mind. And no extra million is worth losing that. Trap 6, you think stuff will make you admired. We all want to be admired. And at some point we start believing if I drive the right car, wear the right watch, live in the right house, people will admire me. But it doesn't really work that way. As Morgan Housel explains, no one is impressed with your stuff as much as you are. When someone sees a Ferrari on the street, their first thought isn't, wow, that driver must be really successful. It's, damn, I want that car. They're not admiring you, they're picturing themselves behind the wheel. That's the man in the car paradox. We buy things to impress people who aren't even paying attention to us. Housel explains it perfectly. Wealth just becomes a mirror reflecting people's own desires to be liked and admired. In other words, they're not seeing you, they're seeing who they could become. That's why buying expensive stuff for attention almost never works. If you're chasing admiration, money is a weak tool, because real respect doesn't come from what you own. It comes from how you treat people. Humility, kindness, empathy. These bring more admiration than any luxury item ever could. So before you spend to be seen, ask yourself, are you trying to impress others or just imagining that they're impressed? Because no one's thinking about your stuff. They're too busy wondering how they'd look with it. Trap 7, you think looking rich means being rich. The fastest way to go broke, trying to look rich. The fancy car, the luxury watch, the exotic vacations, they look like wealth. As Morgan Housel puts it, spending money to show how much money you have is the fastest way to have less of it. We tend to judge wealth by what we can see, but true wealth, it's what you don't see. You see someone driving a $100,000 car and assume they're rich. But what you don't see is the car loan, the stress, or the pressure to keep up appearances. Housel says it clearly. Wealth is financial assets that haven't yet been converted into the stuff you see. Looking rich is about spending. Being wealthy is about not spending. It's the money you didn't use to upgrade the car, didn't flash on Instagram, didn't burn just to feel successful for a moment. Because wealth isn't loud. It's what gives you freedom, time, and peace of mind. And here's the paradox. Most bad financial decisions come from trying to look rich, not trying to be rich. Because looking rich gets attention, but building wealth, it's silent. No one claps when you quietly invest every month or skip the new phone. But those are the moves that build lasting wealth. So if you want to build true wealth, get comfortable with not looking rich, because the path to financial freedom isn't about showing off, it's about choosing long-term peace over short-term praise. Trap 8, you fall for fear disguised as wisdom. Bad news grabs attention, it feels urgent, important. Tell someone the market will crash and they'll listen. Tell them it will rise slowly over the next 20 years and they'll lose interest. That's the trap of pessimism. It feels smarter, safer, more realistic. As Morgan Housel puts it, optimism sounds like a sales pitch. Pessimism sounds like someone trying to help you. Why is that? Because pessimistic stories are fresh, loud, emotional. A 40% market crash makes headlines. A 140% gain over 6 years barely noticed. Setbacks happen fast and loud. Progress happens slowly and quietly. That's why pessimism feels more persuasive even when it's less accurate, while optimism feels naive. But real optimism isn't blind faith. It's not ignoring risk. It's expecting setbacks and still believing in long-term growth. Howell calls it expecting things to be bad and being surprised when they're not. That mindset is what keeps smart investors in the game. And if you listen to every doomsday headline, you'll panic, you'll sell too early, you'll abandon a strategy that could have worked if you just held on a little longer. The trick? Zoom out, look at decades, not days. That's when you see the real story. Progress compounding. Innovation quiet, steady, unstoppable. Optimism takes patience. So next time someone warns the world is going to hell, ask yourself, is this insight or just fear in disguise? The most important financial lessons aren't glamorous. They don't make headlines. They don't promise fast returns, but they're the ones that actually work over years, not weeks. Because in the end, wealth is about staying in the game long enough for your strategy to work. Trap 9. You think saving needs a goal. Most people think building wealth means making more money, getting a raise, landing a high-paying job, finding the perfect investment. Morgan Housel argues something else matters far more. How much you save. You can't control the market. You can't control your income. But how much you save, that's 100% yours to decide, and that's what builds wealth. And here's the key. Saving doesn't always need a goal. You can save just to create options, to wait, to pivot, to say no when others can't. Household puts it clearly. Savings is the gap between your ego and your income. That one line explains why even high earners live paycheck to paycheck. Think of the lawyer making $250,000 a year, driving a new Porsche, paying for private school, dining out 5 nights a week, living in a high-end home with a high-end mortgage. From the outside, it looks like wealth. But behind the scenes, there's nothing left. No breathing room, one job loss, one emergency, and their financial life collapses because their lifestyle grew as fast as their income. That's the trap. When your ego rises with your paycheck, your savings disappear. After a certain point, building wealth isn't about earning more, it's about needing less. Less ego, less pressure to impress, less chasing after things you don't actually need. Saving isn't about what you earn, it's about what you don't spend. It's the watch you didn't buy, the house you didn't upgrade to, the lifestyle you didn't inflate, and the reward, flexibility. The more you save, the more time and freedom you have when life changes. It gives you room to breathe, room to wait for the right job or walk away from the wrong one, room to handle a crisis or seize an opportunity. Because when things go wrong, and they will, it won't be intelligence that saves you. It'll be the space you built by choosing to live below your means. Trap 10. You want the gains but not the ride. Think investing is free. Well, it's not. You don't always pay with money. You pay with stress, doubt, and the gut punch of watching your portfolio drop 30% overnight. As Morgan Housel explains, everything has a price, but not all prices appear on labels. That's the hidden cost of investing. It doesn't come with a receipt. It comes as fear, doubt, and regret. And because that price feels emotional, not financial, most people think they did something wrong. But that's not true. Who explains it perfectly? Think of market volatility as a fee rather than a fine is an important part of developing the kind of mindset that lets you stick around long enough for investing gains to work in your favor. It's not a punishment. It's the price of admission. Take Netflix, for example. It returned more than 35,000% between 2002 and 2018, but spent 94% of that time below its previous all-time high. To win, you had to live through constant discomfort. That was the fee. The problem: most people try to avoid that fee. They chase quick wins, try to time the market, jump in and out. But by avoiding the short-term pain, they often pay double in the long run through missed gains or costly mistakes. So here's the mindset shift. Expect the emotional cost, accept the discomfort. Believe the fee is worth it because there's no free lunch in investing. And the sooner you accept that, the more likely you are to stay in the game long enough to win. Trap 11. You think getting rich is the hard part. It's one thing to get rich, it's another thing to stay rich, and they require completely different skills. Getting rich takes boldness, risk, optimism. Staying rich takes something far less glamorous: caution, humility, resilience. Because building wealth is about offense, keeping it is defense. As Morgan Housel puts it, good investing isn't about brilliance, it's about survival, and survival matters, because if you avoid catastrophe, you stay in the game. And if you stay in the game, compounding does the rest. That's why the best investors don't chase perfection. They build systems with room for error because they expect surprises. If your strategy only works when everything goes right, it's fragile. True strength is surviving when everything goes wrong. And that's the paradox of successful investors. They believe in the future while preparing for everything that could go wrong today. It means holding extra cash not for returns but for flexibility in a crisis, like buying great stocks when prices crash. It means diversifying your investments so one bad move doesn't wipe you out. And most important, it means preparing your mindset because staying calm when others panic is a superpower. Hustle calls this a barbell personality. A healthy mix of confidence and caution. Hope in one hand, fear in the other. Look at U.S. economic history over the last 170 years. Dozens of recessions, wars, crashes, inflation, and still living standards rose 20 times. That's what a real optimism looks like. Believing the long-term trend is up even when the short-term is chaos. Trap 12. You overestimate your plan. Most financial plans look great on paper, but your spreadsheet doesn't feel fear. It doesn't get laid off, it doesn't panic during a downturn, you do. That's why Morgan Housel says, the most important part of every plan is planning on your plan not going according to plan. It's not about building a perfect plan, it's about building one that survives reality. And that means leaving room for error, a margin of safety that helps you endure the unexpected without panic. Because here's the real catch. There's a difference between what looks safe on paper and what feels safe in real life. For that reason, HOUSEL assumes his future returns will be a third lower than historical averages. That one choice helps him save more and sleep better. Because often the problem isn't the plan, it's your nerves. Your strategy doesn't fail when it's wrong. It fails when you can't handle the stress. That's why emotional resilience is just as important as financial resilience. And here's where things get risky. If your whole financial life depends on one job, one income stream, or one big bet, that's a single point of failure. If it breaks, you break. That's why saving without a specific goal is smart. Because the biggest costs in life are usually the ones you never saw coming. As Benjamin Graham put it, the purpose of a margin of safety is to make forecasting unnecessary. You might not have millions, but you have the one thing every wealthy person depends on: time. It's the most powerful force in finance and the most overlooked. Trap 13. You underestimate the power of time. Warren Buffett is worth around $160 billion, but more than $156 billion of that came after his 65th birthday. Let that sink in. He didn't get rich from chasing big returns. He got rich from starting early and staying in the game. As Morgan Housel explains, the most powerful force in finance is time, not talent. But our brains aren't built to grasp how powerful compounding really is. That's why Warren Buffett's story feels so unbelievable. He started investing at age 10. By 30, he was a millionaire. But what made him one of the richest people? I was simply staying in the game for over 80 years. If he'd started in his 30s and retired in his 60s, he'd still be successful, but you probably wouldn't know his name, because compounding isn't just about high returns. It's about earning good returns for a really long time. That's the secret. Most people think smart investing means chasing the biggest gains, but those are often one-time wins, rare and hard to repeat. Real wealth comes from a good return, repeated for a long time without blowing up. It's built slowly, quietly over decades. Think of it like planting an oak tree. In year 1, not much happens. In 10, it looks solid. In 50, it's massive and unshakable. That's the power of compounding. Trap 14. You ignore how rare success really is. One big win can cover a dozen small losses. That's not just luck, it's how success really works. Because in money and in life, most outcomes are driven by a few rare events. They're called tail events. They're hard to predict, easy to overlook, but when they happen, they change everything. As Morgan Housel explains it, you can be wrong half the time and still make a fortune because one breakout win can do all the heavy lifting, and most of the time it does. Think about Warren Buffett. He's owned hundreds of stocks in his life, but nearly all of his wealth came from just 10. Not 100, not 50, 10. See, in 1989, he bought shares of Coca-Cola. It wasn't flashy or risky, but that single investment became one of the greatest compounders in history. That's what tail events look like. Quiet at first, then explosive, and the stock market tells the same story. Since 1980, just 7% of companies in the Russell 3000 index drove all of the market's net gains. Meanwhile, 40% of stocks dropped over 70% and never recovered. That's the danger and the power of tail events. They don't just influence the outcome, they are the outcome. But here's the trap. We love clean stories. We focus on big wins and assume that kind of success is normal or repeatable, but most of the time it's not. So what do you do with that? Stop trying to be right all the time. Start focusing on staying in the game, because most days won't feel important, but a few rare moments, crashes, bubbles, unexpected breakthroughs can change everything. You only need one of them to win big, and the longer you last, the better your odds of catching one. Trap 15. You buy stuff and sell your time. What if the real reward of money isn't a car or a house or even status? Morgan Housel puts it simply: the greatest benefit of money isn't stuff, it's freedom, especially freedom over your time, not luxury but control. Controlling your time is the highest dividend money pays, because deep down we don't just want money. We want more control, more space to think, to breathe, to choose. Housel argues that the ability to control your own life is one of the strongest predictors of happiness, and I think many of us can relate to this. Even if you enjoy your job, doing it on someone else's schedule can still feel like a chore, and today that pressure never stops. We check emails at night, take calls on weekends, stay on even when we're supposed to be off. That constant pressure comes at a cost. Back in 1981, social scientist Angus Campbell ran a study on happiness in America. His conclusion: a strong sense of controlling one's life is a more dependable predictor of well-being than any objective condition we have considered. In other words, freedom over your time beats wealth, status, or success. That's why financial freedom isn't about having more, it's about needing less, not retiring early but living life on your terms. As Morgan Housel writes, the highest form of wealth is the ability to wake up every morning and say, I can do whatever I want, when I want, with who I want, for as long as I want. Who you become when things get hard is what decides whether your plan survives. The hardest part is trusting it long enough to let it work and staying unshakable so your life compounds like your money does. Trap 16. You expect the market to be predictable. The most important events in your financial life, you won't see them coming. That's what makes them so powerful, they're surprises. And yet many investors treat history like a crystal ball. They think if they study the past hard enough, they can predict the future. Morgan Housel calls this the historians as prophet's trap. History is the study of change, ironically used as a map for the future. But in finance, that mindset often fails because the biggest market shifts are almost always unprecedented. New risks, new technologies, new shocks. Yes, history matters. It teaches us how people tend to react. We panic during crashes. We get greedy during booms. History gives us humility because it reminds us that past surprises weren't predicted and future ones won't be either because the world changes. Technology evolves. New threats appear like climate risks, geopolitical shocks, or inventions we've never seen before. And suddenly the old rules no longer apply. So no, history won't predict the next war, recession, or innovation. But it can help you build the right mindset and stay calm when the next surprise comes. Because in investing and in life, calm beats certainty. That's what wins over time. Trap 17. You forget that you'll change. You think you know what you'll want in 10 years, but you probably don't. And that's not a flaw, that's human. Psychologists call it the end of history illusion. We clearly see how much we've changed in the past, but completely underestimate how much we'll change in the future. Personally, I'm nothing like I was 10 years ago. My goals evolved, my priorities shifted, even how I think about work and life feels different now. And I think many of you can relate. Now imagine 10 years from today. What feels obvious or permanent right now, your personalities, your goals, your lifestyle might look totally different. That's why long-term planning is so tricky. We build plans for who we are today, not who we're becoming. You might say, I'll never want kids, or money doesn't matter to me. But 10 years from now, you might want both, and if your plan didn't leave room for that change, you could end up stuck, stressed, or full of regret. Morgan Housel puts it best. Imagining a goal is easy. Imagining that goal under real-life stress is something else entirely. So how do you protect yourself from future regret? Avoid extreme financial commitments. Don't assume you'll always love living frugally. Don't sacrifice everything chasing wealth either. Instead, aim for moderation, moderate savings, moderate working hours, moderate time with family, moderate lifestyle expectations. Because when your life shifts too far in one direction, you leave no room to adjust. And that's often where regret begins. Plans built on moderation are more flexible. They survive change. They leave space to grow without causing you regret. Trap 18. You copy people who aren't playing your game. The fastest way to lose money. Follow advice that wasn't meant for you. It happens all the time. You see someone making quick money. You hear a bold prediction. You feel like you're missing out, but here's what you don't see. They're playing a different game. One of the most important lessons in finance is this: know what game you're playing and don't let someone else's game distract you from it. It's one of the biggest traps in money. Mistaking someone else's strategy for your own. Because the financial world is full of people with different goals, timelines, and strategies. A day trader chasing short-term momentum isn't playing the same game as someone investing for retirement. But when you copy their moves, you also inherit their risks without knowing the rules they're playing by. Morgan Housel puts it clearly: few things matter more with money than understanding your own time horizon, and not being persuaded by the actions and behaviors of people playing different games than you are. Just because your friend made money trading crypto last week doesn't mean you should do the same. That might be their